Well, let's pick up with Daniel Lacalle then, Chief Economist at Tressis Gestion. Good to see you, Daniel.
Good morning.
Welcome. Look, very interesting market reaction around the debt ceiling resolution, at least for the next 3 months or so. I mean, I wonder if the fact that we did get a relief bump and that we saw yields rise again and a bit of a check for the dollar, whether that actually means that the market now thinks that there is a new spirit of bipartisanship between Republicans and Democrats. What do you think?
Certainly. I think that the market was strangely too worried about the debt ceiling this time. The debt ceiling has been raised over 90 times in its history. So this time there was a lot of nervousness around the markets, thinking that it would be a much more difficult process. And I think that what has happened is that as investors, as market participants start to see that it's going to be like any other negotiation, just a little bit more complicated than usual, but nothing less, then you have a little bit of a relief rally. I think that the second phase will be when there's a longer term agreement, which I think there will be. Both the government and Congress are not going to put the country in a default situation.
Well, I mean, clearly you say, the market was too pessimistic.
It was.
But given how divisive Donald Trump has been, surely there was a very real prospect that the government would not be able to pay interest on treasuries.
Well, I mean, not a real prospect. I don't think that the administration was making any comment regarding pushing things to the limit, but I think that the level of lack of understanding that there is, not just with the Democrats, but also within the Republican Party, was certainly helping or fueling this concern, absolutely.
One take is that Donald Trump just couldn't be bothered with this toing and froing that was taking place in the room and just quickly said, well, just do the 3-month extension. But let's just lean into the other side of the story for a moment. Was he the only sensible person in the room? Because they always needed Democrat support to get an extension. And in the past, when they've tried to tie certain bills to other bills, it's backfired. People see right through it. And the key part of some of this funding was getting money to victims very quickly. I think many of the Republicans that have been hard hit in the storms might have seen a very negative turn of events if there was a tying of the debt funding or the debt ceiling to their funding relief.
Yeah.
So has Trump actually done the right thing?
I think he's been smart, at least tactically, to put the ball on the Democrat side, to say, look, if there's not going to be funding for the hurricane relief, if there's not going to be if some of the programs are going to be under threat, it's your fault. So at least from a tactical perspective, that has been smart. We also have to remember that from a budget perspective, the Trump administration is aiming at cuts in the budget, that is aiming for very radical changes in how the government funds itself. Therefore, in this occasion, you didn't have an administration that was actively looking for a debt ceiling raise, because ultimately they would say, look, you don't raise the debt ceiling, then we will implement a much harsher budget than what we had initially proposed.
A slightly deeper read too, perhaps it's Trump looking at how dysfunctional Republicans have been so far. I mean, we're coming up to year end, eventually a couple more months. If nothing gets done, it's a terrible record for Republicans who have control of both houses. So is he almost trying to stop some of the process where Republicans have been embarking on so much self-harm with, I guess, wide parts of the party from conservative to more moderate centrists? He's trying to stop this before the midterms and actually get something done. Now with the situation where mid-December the issue comes up again, it's going to require a lot more bipartisan support for bills, all Republicans to all side together to get legislation through. So is he almost taming the rebel part of the Republicans?
Absolutely. I think that what Trump has got to the point is to say, look, if everything is going to be blocked, it's not going to be me who's to blame. It's going to be you who's to blame. And what he's basically trying to do is to get the Republicans to be clear about policies. You cannot say that you're going to repeal Obamacare and at the same time not do it. You cannot say that you want tax reform and you want lower taxes to your citizens and at the same time avoid it. So he is actually playing more against, I wouldn't say against, but playing more more to get the Republicans to be on his side rather than trying to appease the Democrats, which is a much more complicated issue.
Yeah, it's a fascinating.
For that, and even as we speak here about the prospect of new sanctions, we have some headlines coming through from a UN panel that is investigating the effectiveness of the current sanctions regime. The panel citing lax enforcement and North Korea's evolving techniques to bypass the effectiveness of sanctions. The panel says international sanctions against North Korea are being subverted, which does raise some interesting questions then about how to make any future sanctions more effective at this point. I got a question for you, Daniel, and it's about this weekend. It is North Korean National Day on Saturday. There are concerns that there are preparations being made for a new ICBM launch. Probably will happen on Saturday because they do like a show around this National Day. Would it be a good idea to lighten up on risk assets running into the weekend? Because every time we have one of these launches, markets take a little bit of a dip.
Sure, and definitely on hyper-cyclical stocks or on very aggressive emerging market exposure. If you think about it, even if we have and I think that we all hope that all of this will not end in a conflict, but the process of tensions definitely shaves off a lot of the optimistic expectations about global trade in particular. Let's remember that about 4% of global exports come from South Korea. Therefore, these things tend to cool off, particularly if you're very optimistic about growth expectations and about the valuations that you're taking into your portfolios. Therefore, I think that we need to be at least cautious, but also, it's important to think that the implications of a prolonged tension period are not small. If the US starts to impose some kind of a sanction or at least puts barriers to trade with the main trading partners of North Korea, we're talking China, Russia, India, Pakistan, it's not small. The impact also on global trade is not small. The impact on the oil market is not small.
Excellent. Thanks very much indeed, Annetta, for that. Daniel Lacalle is with us, Chief Economist at Tressis Gestion. How can Mario Draghi not address the euro today, given that a stronger euro is undermining the ECB's inflation target?
Completely. He has to do something, and market expectations are very low, basically because he's in a very difficult position. On one side, he needs to talk about tapering, and he needs to give a path of tapering, because with 1.7 trillion euros of excess liquidity, the ECB is running out of bonds to buy in 2018, and I think that at the same time, the economy is growing in a positive way. But on the other side, the entire QE effect on inflation expectations and on the currency have round tripped. So where inflation expectations are coming down, and obviously as the euro gets stronger, the inflation expectations will be coming down harder. So I think that he needs to address that situation, because the market right now is positioned for probably a too optimistic view about growth in Europe, too optimistic, particularly relative to the US. And at the same time, he needs to give a message that doesn't bring the euro much stronger. However, he also needs to be firm about tapering, because too many governments in the Eurozone are growing accustomed to very low rates, and they're starting to talk about increasing deficits and going back to the old mistakes of the past.
Ladies and gentlemen, I think we're stronger than we were on the euro, but we're not in a strong euro environment. There, I said it.
You said it.
There you go, I said it. I've just pulled out a very long chart. Well, I say long chart. I've gone back to 2008, so I've got a 10-year chart. And if you look at the near-term history down to the lows in 2014, 105, and again the lows in 2016, 105 again. But if you look at the long chart, let me just talk to you throughout the financial crisis. In 2008, July, 157.
Yeah.
Then it went down, then back up again. November 2009, 149. Back up again, 2011, 143. 2014, 138. So I know we're getting all exact, and it has had a breakout, Karen, and undeniable compared to all our city rounds before about 108 or 109. But it's nowhere near the average where it's been over its lifetime. So,
but it's never about averages, is it? It's always about what happens in a time frame, and when you get such a rapid ascent in a short period of time, it makes it very, very difficult for companies and also for a number of the banks in the region.
Between, and if I may start the chart at February 2015 and now, so it's only literally 2.5 years that we've been stuck in this 105, 112 range. We've just got a bit of a breakout on that. So I do think it's important to just put this in context. Excellent chart on the screen. They're just showing a little bit of the longer term.
Yeah, but if you think about it, what has happened as well is that throughout that period, monetary policy has gone through the roof. The ECB's balance sheet is now almost 36% of the GDP of the Eurozone. The interest rates are at zero. So it is, yes, that would be an acceptable argument if we had the same monetary policy we had under Trichet, which was quite accommodative, despite what many people give him credit for. But at the same time, we also have to think that neither the growth prospects, especially relative to the US, neither the demand and supply of euros relative to the market are improving. Therefore, I think that things have changed, and at the same time, you have an absolutely massive accommodative policy from the ECB.
Okay. We'll come back.
Second independence referendum on the 1st of October. A majority of lawmakers in the Catalonian parliament voted to hold a vote on becoming an independent state from Spain. Spanish Prime Minister Mariano Rajoy said that the government would bring the full force of the law against the vote. A previous one held in November 2014 was declared unofficial by Spain's Constitutional Court. Daniel, you and I were talking about this one off camera, and of course Catalonia, the region where there's been enormous terrorism activity, which is behind the recent attacks that we saw in Spain. So does that have an influence on the bearing around a constitutional vote?
There has been an influence, and predominantly because of the, let's say, of the questions about how the investigation and the management of the regional versus national coordination happened. So it will affect, but I think that...
So the regional government's taken a blow, is what you're saying?
The regional government is being very questioned, and the whole way in which the vote has been put forward in Parliament against everybody in the opposition, completely illegal. It wasn't. There was more time to have lunch than to discuss the details of what was voted in Parliament.
Good tappers in the region.
It is a very, very challenging situation, but from a legal perspective, it's completely illegal. It will not be enforced, and the referendum. I mean, you don't even have any of the legal requirements that have been, the points have passed in that level.
The reason why this was so important, though, is because there was a broader story about exits across Europe, and Brexit, of course, has happened, and others were saying, well, who's next? Will it be the Spanish because you have the Catalonia vote? Will it be the French coming up to the election at the start of the year? Will it be the Italians next year if you see more factions start to separate from the mainstream parties? Do you think we're done with exits and Brexit pretty much will be it, or do you think there's going to be more in coming years?
It's going to continue, because the issue with nationalism all over Europe is that it's not based just on separation. It's based also on including other regions. It's not just saying we want independence. We want independence, and we want to include a few other regions to our imperialistic desires. So it will continue, and more importantly is that as the European Union continues to address these issues from a very sort of loose perspective, it's not going to die anytime.
Just one for me. Isn't there a stunning contradiction going on here from authorities? Because on one hand, you've got the European community, European Union, Eurozone, trying to erode the abilities of sovereign states, nation states, to have their own powers and what have you, whether you like it or not. We call it federalism, whether you see it's a good thing or bad thing. They want more supranational organisations. So at a pan-European level, you see an erosion of the sovereign state. And yet, at a country level, they are so worried about the breakup of a sovereign state. So they're worried about the Basque region, they're worried about Cornwall, they're worried about Scotland, they're worried about Catalonia, but they don't mind at a pan-European level breaking up the sovereign state. It just seems to me a huge contradiction. You can erode it from one side, but you're not allowed to erode it from the other.
Well, I think that there's a difference. Is that when you reduce your when governments accept to lose some of their sovereignty to that supranational state, the European Union, whatever, is because allegedly at least there is a perception that there's a benefit and there's some efficiency. On the other side, it's about bureaucracy. The first thing that you've seen here in Catalonia, for example, is that the first thing that they do is to hire a bunch of 100, 800 new public servants.
Gosh, it sounds like a European finance ministry.
Because the EU is so efficient that it has 2 parliaments, one in Strasbourg, one in Brussels, and they ship everything between the 2 at least twice a year. That's the efficiency of scale, isn't it, Daniel?
But that's the funny thing is that what I find fascinating is that all these secessionists on one side, they want that level of independence, which they will not have because of the powers that have been given to the European Union, and at the same time they want to stay in the European Union. So it's not about sovereignty; it's about bureaucracy. That's a big difference.
Look, these nationalist movements, in my mind, are economically driven. Ultimately, everything comes down to how people feel about their economic future. It's why we have Brexit in this country. It's why the Scots Nats did okay. It's why that this issue has now become alive again. People have not felt that their economic welfare is improving. Therefore, they look to other remedies, and extremes right and left tend to benefit from that. Which brings us neatly back to the ECB, because I just want to refocus on this for a moment. The technical committee apparently has put proposals on the table for tapering. It's created scenarios about the withdrawal from QE. What is the risk, as we run into the weekend here, of a bond market problem, that we get a sell-off in sovereign bonds, that we get another taper tantrum if Mario Draghi's communication to the market is flawed? And we've had a few recent examples where he said one thing and the market has done something different, and then the ECB has had to come out and clarify what was said. Is there a risk of a policy mistake in the statement?
There is obviously, because when you rely on very big changes in market indicators just due to communication, it is very likely to be misinterpreted or exaggerated, obviously. But I would say not in the sovereign bonds, because as we were mentioning before, even with tapering, the ECB is running out of bonds to buy in 2018. But definitely on other risky assets. Look at the performance of small and medium caps in Europe. It's been absolutely stellar. Look at the performance of banks. Look at the performance of let's say, more aggressively cyclical oriented stocks. So that's where you can have a tantrum.
And I think the market is alive to the risk here. I mean, you've only got to put that euro-dollar rate up and just look at where we are on the live quote. This is becalmed. This is like, you know, you're out on a boat and there is absolutely no wind and you are stuck there heading in no direction, because I think that the traders are sitting on their thumbs this morning and they're not pushing this around too much at all, because you look at dollar sterling and that's active, and you've got the yen active as well here against the dollar, but euro-dollar, be calm. Nobody wants to take the risk.
I think almost the opposite, because there is a big chance of disappointment today, and if anything, you'd be looking at almost pulling back on positions because there's so many longs, euro longs in the market, the second biggest positioning of Forex. Surely there would be a little bit of softening up coming into the conversation, just in case of disappointment.
Look, the price movement is the price movement.
Investors are pushing it higher. So if anything, they're pushing Draghi to do something. I think it's quite interesting, the price action, if anything.
Yeah, it will be. I think you have to look at that, but I think that the risk of exaggerating or misunderstanding some of the messages of Draghi is high. Basically because he can't say many things,
Yeah.
and therefore, like in Jackson Hole, remember the movement just for saying that that regulation is good. Basically, that's what he said in Jackson Hole, that regulation is fine, and suddenly the euro went through the roof. So you have to be a little bit careful about.
There's also a disconnect too, if you look at the strength in euro pushing it higher, so investors thinking there might be some form of a taper. But if you compare that to the banks in Europe, the trade for the European banking stocks has been much weaker in recent weeks. In fact, almost the polar opposite of the euro-dollar rate.
Yeah.
So to me, when you talk about a taper tantrum, isn't it already happening in some of those banking stocks?
It is happening in some of the stocks in Europe, yeah.
All right, let's move on. We'll come back to the conversation. Facebook has reportedly turned over information about US election ads to investigators probing Russian meddling in American politics. The company revealed it found an operation likely based in Russia spent $100,000 on political ads with what it called divisive social and political messages. Facebook says thousands of ads and hundreds of fake accounts were active around the US presidential campaign.
This is just going round and round in circles, isn't it? Yeah. So the Russians were involved in some way, shape or form, whether it was state-backed or not. A lot of us have our views in the election of the president. Fine. Is there a connection between President Trump and these campaigns? No one's found a smoking gun. We get going round and round in circles. There are so many investigations, not just Robert Mueller's going on. And look, it's not for me to defend the president, it's not for me to say that he's done anything wrong. But the fact of the matter is, how many investigations now have found a direct link between the president and all this activity?
It's another layer too, though. Don't forget, this is about media independence, and you've got Facebook as a key influencer these days. It's one of the top social media sites, and you've got ads that are targeted by geographies towards people who are undecided voters when you've got a very, very close vote. It's quite important for the democracy of the nation to work efficiently, and if media's been compromised in that sense, I think it's something that regulators should at least take a look at. The other point I would make, it was only $100,000. I wonder how far that goes on Facebook these days.
That's the thing, is that we're talking here the difference between uncomfortable presence and direct implication. And I think that you know, for a businessman that has been present all over the world, it's logical that he had some business with Russia. And the same here with Facebook. I think it's very, very difficult to find that link that you were mentioning, and that it's not because of lack of trying, definitely.
Just one point to make here. How many fake accounts are there actually on Facebook anyway that have nothing to do with Russia?
Well, there are more
is this a
Facebook
smokescreen?
accounts for young people in the UK than there are young people in the UK.
Absolutely.
We are going to take you to the market action shortly. Stay tuned. All the opening numbers coming your way.
Hey, thanks very much indeed, Karen, for that. Chris Wiley is with us, Chief Investment Officer at Connor Broadley, I should say. Welcome, Chris. Nice to see you this morning. We've got an interesting analogy to kick off with here. Gone with the wind is how you begin your investor presentation for us. Why is this a relevant metaphor for financial markets currently?
Well, the starting point for that was that Gone with the Wind remains the highest grossing movie of all time, but only if you adjust for inflation, of course, because the film was released in 1939, December 1939. But adjusting for inflation, it's still the highest grossing film. So it really serves as a reminder as to how important inflation is. And of course, I can extend the analogy to say that many investors can find their portfolios gone with the wind of inflation over time if they don't invest. And the point of making that, I mean, that's well observed, everyone understands that. But at a time when interest rates remain extremely low, less than inflation, it's a reminder that being defensive, being cautious in markets comes with a cost. And if you stay there too long, you will find your portfolio, your returns gone with the wind, even whilst inflation is quite low as it is at the moment.
What do you put in that portfolio currently then to give you the opportunity to outperform inflation, given that at the moment returns are suppressed by very low interest rates across most asset classes?
They are. I still believe that equity markets still have a big role to play there. Certain markets, the US most clearly, look quite expensive. Your expectation of future returns from the starting point would be low. But other markets, that's much, much less true. And certain sectors of the market are still subdued and offer good returns. But also in your defensive part of your portfolio, there are still opportunities outside of government bonds. Taking a measure of credit risk can give you a lot more return still. So a little bit of lateral thinking is required in the way you build your portfolio.
Daniel's going to come in next, but just spell it out for us. What stocks, what markets, what opportunities?
Okay, well, within the US, let's take, I think there are two sectors, two big sectors at the moment which stand out as still offering a value opportunity, and that's the energy sector and the banking sector. So the energy sector, because of the oil price being subdued, and the banking sector, because interest rates have been subdued, and because of regulation. And in both respects, the pressure may be coming off, and that could allow those two big sectors to drive the return of the index, even if other sectors are overheated and perhaps will tread water or even fall. And then outside of the States, actually, virtually most equity markets you look at are not outrageously expensive. Europe, well, some of that's happened this year already, that's manifesting. I think emerging markets still have potential. Japan is still not an expensive market, could deliver good returns. So actually, you're not bereft of opportunity at all.
When you look at, you mentioned two very contentious sectors, the energy sector, the financial sector, traditional value traps. They're always cheap. They always look cheap, particularly the energy sector. And on top of it, you're mentioning the saturation of stimulus. You're having less inflation than what the markets were expecting. You have, at the same time, growth continues to be subdued, although healthy. So the problem for many of these sectors is that they're not getting the tailwind of the stimulus. However, they're not getting either the benefits of their alleged defensiveness because they've gone too aggressively into investing into the cycle. That never happened. So one of the risks that I think that for a conservative investor you find is that the level of risk that you have to take now to achieve a little bit of return, like you were mentioning, and to fight against financial repression is much larger probably than what the defensive mindset would entail. No?
I think people have thought that. I don't think it's necessarily true, in actual fact. And if you take start with the value trap observation, well, wherever you find value, there will always be the accusation that it's a trap. You know, that's why prices are low, because people perceive it that way. If people didn't think it was a trap, they'd invest in it and prices would be higher. What you're really telling me is that they perform poorly over a prolonged period of time, and that's what creates that perception. And it also is what creates the opportunity. The question is there a catalyst to change that dynamic? And the catalyst for the banks does still need to be rising interest rates,
sure.
And that the difference between long and short-term interest rates, the difference between those creates an opportunity for banks to make money, and I think that catalyst is in place, as well as the catalyst from regulation easing off. You know, we've got changes at the Federal Reserve, which is, you know, perhaps responding to the Trump agenda of less regulation on the banks. And in the energy sector, well, you know, it's the big one, it's the oil price. You know, has it bottomed? Some evidence, if you just look at the price action there, that might be the case. We might be waiting a while longer. But come back to yield. You know, in both cases, you're getting yield. Over the long-term income return generally gives you 2/3 of your overall total return. So starting with a yield, you know, gets you a fair way there. And on your point about taking more risk, perhaps excessive risk, well, if we look in credit, my point about credit, I'd say in certain sort of plain vanilla sectors, yes, high yield's a good example. High yield in the States, traditional unsecured, you're having to take a chunk of credit risk to get not a lot more return. Right. But where there's less liquidity, you can still find it. So the so-called alternative credit space, we can find things giving 5%, 6%, 7% where we think we're taking a very well-controlled level of credit risk.
I want to ask you about hard assets, and there's a famous line in Gone with the Wind, land is the only thing that matters, and there's Scarlett O'Hara clutching the dirt and shaking it to the sky. Does land become relevant again if you've got an inflation story unfolding at all in the next 10 to 20 years where you've got REITs or even hard assets in the way of homes or commercial property? Does that start to have any merit for investors long term?
Yes, I think it does, and thank you for that, because that's another great sector to talk about where, you know, where I think you can still find good returns without taking excessive risk, and it comes back to that yield. So absolutely, and I think those sorts of real assets offering inflation plus returns at a time that government index-linked bonds are offering you inflation minus returns, you know, those remain attractive.
Just to be clear, how many hours have you spent watching Gone with the Wind?
Too many.
7 hours, is it?
It's very long. There's 2 parts to it.
It is 7 hours, isn't it?
It's 7 hours.
No, it's not 7 hours.
Is it not?
I don't think it even gets to 3 hours.
Just feels like 7 hours.
Yeah.
No. I tell you what, I'm 3 bid at 7. There you go. I'll be 4 bid. Any hitters? 5 bid? 5.5 bid.
No. No.
6 bid.
No.
No.
No one's going to hit me.
In terms of watching it.
No one's hitting the bid. You're kind of so it's not 7 hours, but you wouldn't hit me on my 6, would you? God, a lot of you.
I must say,
on
I've
you.
watched it the most, though. I used to watch it on repeat on the school holidays. Let me take you to more stocks where we're seeing some action today. Imperial Brands. It's announced it sold 13.3 million shares of Logista for £230 million. It will continue to own nearly 80 million shares in the company following the sale. The stock 2.6% north. And to the autos, as I was mentioning earlier, big story unfolding around the auto sector and the way investors are viewing consolidation against some of the negative news that's already been baked into the stock prices. Volkswagen may have found a buyer for its motorcycle group Ducati. According to the Economic Times, India's Eicher Motors is preparing a $1.8 billion to $2 billion bid for the motorcycle manufacturer. Previous interested bidders, including American group Harley-Davidson and India's Bajaj Auto, have been some of the names bandied about. And pilots at Thomas Cook Airlines will strike later this week in a dispute over pay. This after a judge refused to stop the industrial action. The company, however, said all flights will operate as planned. Good news for those still trying to get last bit of sun across Europe, 6/10 north for the stock price. Steve.
Thank you. UBS Chairman Axel Weber is currently speaking at Handelsblatt banking conference in Frankfurt. He's speaking in German, but of course we have some great German speakers around the desk. Daniel, you speak German?
No, not at all.
Oh, God, OK. Chris?
French.
OK. Well, when we see it on the wires, we'll tell you what it says. By the way, no one hit my bid, but I have to say they should have done. They should have been hitting it furiously. About 4 hours with intermissions gone with the wind.
So I was right.
So what, you didn't hit the bid.
That's the longest version.
It
Let's
was
come on.
£50 a point. You could make
careful with the
£100 for a
fake
charity of your
news
choice.
here.
Where are the hits?
I remember it used to be on 2 VHS tapes. So
I want to play poker against you after the show if I didn't have somewhere else to go. Right, OK, Karen, what's coming up?
Of Connor broadly, Daniel Lacalle is chief economist at Tressis Gestion. Gold. Let's talk a little bit about gold. Is there a stealth bull market going on in the mining sector at the moment? And in particular, is it around the gold miners, and should you own gold?
Yes, is the short answer. We do own gold. In fact, the last time I was on this show a few weeks ago, it's what we talked about. And the price has rallied quite nicely since because of the geopolitical tensions. But that's been a catalyst. But I think it was the rally you refer to was already had its foundation stones in place. So what's it about with gold? Well, it comes back to this earlier discussion we had about interest rates, and that gold tends to do quite well as long as you have negative real interest rates. So interest rates less than inflation, that tends to be quite beneficial to gold, plus the fact that, of course, it's inversely correlated to markets, so it tends to go up when stock markets go down, so that's an attractive feature, and we see that as better than government bonds at the moment. That's our preference, so that's the category we put it in. But you're right about broader metals as well, and that's a very, very interesting thing. Stealth bull market's a good way of putting it, because it is kind of, it's behind the scenes, it's not really being recognised, and I'm not sure it's fully understood yet as to exactly why this has happened, but it's maybe one more telltale sign that the global economy actually is in pretty good shape.
I think that the other thing that you have to take into account is that for gold is that what you're seeing right now is the evidence that the market is facing a more prolonged period of financial repression. Is that you're going to continue to see central banks easing that the current pace, even though the economy is completely out of recession. You have central banks printing $200 billion a month, the major central banks. So obviously, when that doesn't come with the growth expectations and the inflation expectations that everybody assumed, then drives currencies lower and puts the risk back on metals and on
Why isn't gold higher then, if there's so much money sloshing around the system? And I take what you say about valuations, and then people like me who are traditionally more cautious need to take on board that, so I will. But bear in mind, we were up, what, $1,800 a troy ounce at one stage in 2012, late 2012. Why aren't we higher on gold, given all of this money and all this concern about valuations?
I think that's one of the things which makes gold rather attractive at the moment, is that at a time when other sort of similar assets, particularly if you put it under that category of inflation kind of linked assets, which have still very high valuations, you're right, gold is well below where it was. Why is that? I think a number of reasons. A lack of yield at a time when yield is still very popular. Also some supply and demand issues, the fact that emerging markets, big sources of demand for gold in the past have been through a choppier time, but that dynamic is shifting as well.
The bear trade's not really been rewarded either, right?
Exactly.
In many cases, and that's just another segment of the market where you don't want to be too bearish by holding too much safety, because you're just going to get wiped out in the position if sentiment improves. I wanted to ask you about short-termism in stocks, and I think resources and autos might be a good example, where you've got the market saying, well, China's going to slow down, surely you need to be cautious around some of the prices, but then we had better signals out of China and the market's been sort of taken aback and almost surprised by the strength, so basic resources have shot higher again. A little bit like autos too, where people know there's long-term challenges, but they're buying back into the sector today because it's all about a price, and also yesterday. So is there short-termism and tactical trading now that's really pushing some of these sectors around, because people know there are challenges in 6 or 12 months, but they're willing to buy the stock today because of the price?
Yeah, I think there's an interesting sort of syndrome around all of this at the moment. And the way I'd put it is to say at the beginning of this year, us, like many other investors, were saying, look, the market's due for some sort of correction. But we did point out that corrections come in different shapes and sizes, and not necessarily, a short, sharp fall. It could be a rolling correction, so where markets sort of pause for breath. I think that's what we've had, really, is more of that. But it does look as if it could be coming to an end now. And the reason to think that the next move could be up again is because all the while in the background, the global economy has been ticking along quite nicely and with good breadth. You look at now US, the European bloc, China, actually some of these indications that the Chinese economy is pretty robust. So that's a really good broad platform. And people have been distracted by these other sort of, sources of risk. But meanwhile, that rising tide is raising all the ships.
And we'll wrap it up on that. Lovely to see you. Thanks very much for coming in for the half hour. Chris Wiley with us, Chief Investment Officer of Connor Broadley. We'll take the break. We'll be right back. Everybody stay with us. When we come back, what is Mr. Draghi going to say today? We will pontificate, speculate, and talk more about where the European Central Bank is headed. Thanks very much indeed, Sri, for that. Let's just take a look at how the banks are performing here as we run into this ECB meeting today. Generally, as you can see here, the banks are performing relatively well. This is a chart, obviously, that shows us broader performance for the banks over the recent period. But I want to show you one bank that isn't doing so well here. Let's pop up the board of Liberbank. Liberbank is down sharply. This is a Spanish bank that is in the process of raising capital. The bank is seeking 500 million euros to shore up its finances. It has in excess of 5 billion euros of non-performing loans on the books at this point. Daniel, why does Liberbank still exist in a world where the European banking sector has apparently been cleaned up by the ECB and by national governments?
Sure. I think that you said the word apparently, and that is the problem, is that the European banking system has not cleaned itself up. It continues to have more than 900 billion euros of non-performing loans, and basically it's just being, the only thing that we've seen is a kicking the can further, and that's been the problem. So what happens with Liberbank is a mirror of what happened with Popular. If you remember the bankruptcy of Popular and its rescue by Santander, is that the bank has been delaying the solution of its very aggressive non-performing loan issue, trying to find a buyer. Obviously, a buyer didn't appear. There's a short ban on the stock, and still you can see that it's plummeting. And it's doing a capital raise of more than 55% of its market cap as of yesterday. And still, after the capital increase and with the numbers that the bank has provided, it'll still have a very significant non-performing loan ratio at about 12.5%.
And whilst I agree with you, how does it still exist this far down the road? Isn't the point is if the government's not involved or it's not a bailout from regulators, why do we don't care? In fact, this is a private mechanism working in the market if you can raise your own money. But if the state has to come back in again, this is where I have problems with the state versus pan-European rules, and this is where there were big contradictions on the bailout of the Veneto banks.
Sure. I think that the issue is, on one side, governments in the Eurozone don't want to resort to nationalization or to rescuing, bailing out the banks after the tremendous political backlash that generated in the past. And at the same time, the banking system is not cleaning itself up because it's basically trying to sort its problems in an environment that goes against itself, you know, with very low inflation, with negative real rates. Therefore, selling non-performing assets is very complicated, and at the same time, it's very difficult for them to generate positive margins. This is another example of why the Eurozone is not advanced in the improvement of its non-performing loans issue.
Thank you so much for the explanation. Daniel, good to see you. Thanks for being our guest
Always
host.
a pleasure.
Daniel Lacalle.